counting macros. Let's look back on the week of July 19th, see what we got. It was a relatively quiet week, data-wise. On Monday, we got leading indicators, which were at negative 0.2%. All that means is month over month, it was a 0.2% decrease, and now the reading's at 99.1. Note that the baseline reading is pegged to 2016, which is 100. The report just generally showed that weak consumer expectations played a large negative role in that reading, but there was still strong spending from the AI build-out, so it wasn't terribly impactful. On Monday, there was also a Fed board meeting that was closed. On Tuesday, nothing but another closed Fed board meeting. Nothing to report on Wednesday. Thursday, we got weekly jobless claims, 187. If you were keeping up with weekly jobless claims last week, you'll know that last week it was 208,000. So massive decline. Forecast for this week was 212,000. Obviously, there's going to be like some moving averages to account for this random volatility that they're going to be looking at, but the job market is looking increasingly more stable, and this is like the best jobs data in terms of weekly jobless claims that we've had in a very long time. On top of that, on Thursday, we got the Kansas City Fed survey. Generally, respondents showed okay signs for manufacturing. Data center and data center adjacent construction is masking underlying struggles in housing and non-residential construction, which is sort of a theme that I think we've seen for a bit, and we're going to continue seeing. If you remember that farm economy little blog that I put up on the open market operation website, I think last week, very similar idea. Generally, I think respondents are showing expansionary expectations for the future, but it's sort of uncertainty in the present. On Friday, we got flash manufacturing and flash services PMI. As far as manufacturing goes, there was a 53.8 reading. People noted improving manufacturing conditions, but still below forecast. I think this is likely constrained by supply chain related issues given the resumption of the conflict in the Middle East. Flash services PMI was at 53.6, with sectors showing growth and this being above forecast, although potentially bolstered by the recent World Cup. New home sales were released on Friday as well, 628,000. This is above forecast and an increase from the last reading of new home sales. So because it was a light week for data, I thought we would look at some other stories. Last Sunday, it was announced that changes were coming to how the BEA, Bureau of Economic Analysis, calculates PCE. So it's going to retroactively push core PCE readings down roughly 0.2% due to some sort of methodological changes. Obviously, this doesn't change price level, but it just changes how, I guess, they interpret it and how maybe policymakers look into that. Another thing that I really thought was interesting was the odds of a rate hike. Obviously, the Fed's been meeting this week, and the FOMC will release their interest rate decision on this coming Wednesday, July 29th. Maybe last week, I thought, there's chance for a rate hike, not necessarily likely in July, but there was definitely a chance given the resumption of the conflict in Iran and the fact that we got very encouraging jobs data this week. I thought that it was a perfect time for the new regime that Warsh wants to bring in to sort of flex its muscles and show, the country and the world that it's there, right? Obviously, Warsh has, testified in front of Congress and said that the Fed under him has no tolerance for inflation and wants to end forward guidance and all these sorts of things. But I think the biggest thing that sort of stuck with me was that he wants to be proactive. Obviously, he has a very data-driven approach, but the feeling I got from his testimony and generally the way he speaks is that he wants to get in front of inflationary pressures before they get out of control, and wants to end the sort of last 5 to 6 years of very elevated inflation. I want to know whether Warsh is really taking the zero tolerance thing in terms of an activist sort of policymaker way, or in a reactionary, we're going to be strict on it, but we need to see all the data first, which is something I feel like he's been decrying for a long time and not been very happy with the Fed about in their approach. And for me, I think that you have very encouraging jobs data that shows over weeks, over months, that the labor market is cooling, but it's still stable. And you've had persistent inflation, persistent core inflation. And you saw even when the Iran war ended, that core inflation stayed steady. Now the war is resumed. I think this is a perfect time to hike. Obviously, I'm not a policymaker, and there's a bunch of other considerations I have to keep in mind. But this is just a thought of mine. I think the market's pricing in roughly like a 75% chance of a hold in July. I would be very surprised if we don't hike at least once this year though. But I think, if Warsh wants to really put himself out there, he'll do it, or the rest of the board and him will do it in July. On Thursday, there was a major stock sell-off, particularly in the Mag 7, which I found interesting. An example of this is Alphabet. They reported, I think, a 24% increase in revenues, but they also reported negative cash flows for the first time in company history due to just the amount of capex on AI and the AI build out. I don't think the bubble signs are like very clear yet, but they're, just something to keep in mind. Also, Trump's new tariffs came in effect yesterday. They're backed legally this time by Section 301 of the 1974 Trade Act, which essentially lets the government levy a punitive tariff due to the presence of forced labor in supply chains of other countries, subject to an investigation. So, of course, the White House has put investigations, legitimate or not, but has put investigations out on basically 99% of the U.S.'s trade partners and levied a blanket 10 to 12.5% tariff on all of them, basically just replacing the tariffs that were in place but deemed unconstitutional. I think the general consensus is that this is purely illegal backing, and Trump and his administration really just wants to reinstate the tariff regime that they had pre-SCOTUS interference. Given that these tariffs are similar to the previous tariffs that were in place, I don't think this is going to have a massive sort of like outsized impact on inflation or trade behavior or anything like that. I think we've already sort of adjusted to that since Liberation Day. But given that there is now legal precedent for the administration to levy these tariffs as negotiations happen or don't happen and geopolitical developments occur, there is definitely a potential for more tariff action in the future, which could have an outsized impact on businesses and consumers as these sort of levy rates go up or down, et cetera, et cetera. But that's not something we can sort of predict for now. That's it for sort of the data drop and other interesting stories. Be on the lookout for more.